Today, we will talk about advanced stock market investment strategies. In today's rapidly evolving and complex financial landscape, it's more important than ever to stay ahead of the curve and be prepared for the opportunities and challenges that lie ahead. In this blog post, we'll delve deep into the realm of advanced investment strategies, encompassing sophisticated techniques and cutting-edge tools designed to maximize returns and minimize risk for seasoned investors. 1. Quantitative algorithmic trading. This strategy employs mathematical and statistical models to make buy and sell decisions in the stock market. By analyzing historical data, patterns, and market behaviors, algorithms predict future price movements. Once set, these automated systems can execute trades at a speed and frequency unattainable by human traders. They reduce emotional biases, ensuring decisions are based solely on data. Due to its complexity, this approach requires a strong foundation in both finance and data science, and is often employed by hedge funds and institutional investors to maximize returns and mitigate risks. 2. Pair trading, long-short strategy. Pair trading is a market-neutral strategy, aiming to profit from market discrepancies between two related securities. Typically, an investor goes long buys on a stock they expect to outperform and short sells another stock they expect to underperform within the same industry or sector. The net profit comes from the difference in performance between the two. The goal is to hedge against market movements, as the profit from the outperforming stock should offset the loss from the underperforming one, and vice versa. This strategy is reliant on the investor's ability to accurately identify and pair securities with diverging prospects. 3. Dividend growth investing. This strategy focuses on investing in companies known for their history of consistently increasing dividends. Instead of chasing high dividend yields, the emphasis is on the growth rate of those dividends over time. The rationale is that companies that can steadily raise dividends likely have a sustainable competitive advantage, strong financial health, and prospects for future growth. By reinvesting these growing dividends, investors can compound their returns. Over the long term, this approach not only provides a growing income stream but also has the potential for capital appreciation as the underlying stocks increase in value. 4. Momentum investing. This strategy involves buying stocks that have shown an upward trend in terms of price and selling those that have shown a downward trend, based on the premise that stocks in motion tend to stay in motion. It relies on technical analysis more than the fundamental analysis, focusing on stock price movements and trends rather than company fundamentals. Momentum investors look for stocks with strong recent performance, hoping that momentum will continue in the same direction. This approach often requires rigorous discipline and a clear exit strategy to protect gains and minimize losses. 5. Covered call writing. A covered call strategy involves holding a long position in an asset, typically shares of stock, and selling or writing call options on that same asset. The goal is to generate additional income from the option premiums. This strategy can provide a buffer during flat or slightly declining markets. However, it limits the upside potential since, if the stock price rises above the strike price of the call option, the stock might be called away. It's a conservative strategy ideal for investors seeking incremental income and not expecting significant appreciation in the underlying stock in the near term. 6. Value averaging. Unlike dollar-cost averaging, where a fixed amount is invested regularly regardless of share prices, value averaging adjusts the amount based on the performance of the investment and a predetermined growth path. The investor decides on a target growth value for their investment over time and contributes more when the investment is underperforming and less or sells when it's overperforming. This strategy aims to purchase more shares when prices are low and fewer shares when prices are high, potentially leading to better returns compared to dollar-cost averaging, especially in volatile markets. 7. Arbitrage opportunities. Arbitrage involves taking advantage of price discrepancies for the same asset across different markets or platforms. An investor buys the asset in the market where the price is lower and simultaneously sells it in the market where the price is higher, pocketing the difference as profit. This strategy is often executed quickly and in high volumes to maximize returns, as price differences tend to be small. With the advent of technology and algorithmic trading, arbitrage opportunities can be spotted and acted upon within milliseconds, making it a domain often reserved for institutional traders with advanced systems. 8. Sector rotation strategy. This strategy involves moving investments between business sectors based on macroeconomic indicators. The idea is that certain sectors will perform better at different stages of the economic cycle. For instance, during an economic expansion, technology and consumer discretionary stocks might be favored, while during a downturn, utilities or healthcare might be preferred. Investors using this strategy aim to capitalize on these shifts by overweighting sectors predicted to outperform and underweighting those expected to underperform. Proper execution requires a deep understanding of economic trends and how they impact various sectors. 9. Option spreads and straddles. Option spreads and straddles. These are advanced options trading strategies. Option spreads. This involves buying and selling multiple options contracts on the same underlying security, but with different strike prices or expiration dates. Types include vertical, horizontal, and diagonal spreads, each with its own risk and reward profile. Straddles. A straddle involves buying or selling both a call and put option on the same underlying asset with the same strike price and expiration date. It's often used when an investor expects a significant move in the asset's price, but is unsure of the direction. Both strategies aim to capitalize on price volatility and limit potential losses. 10. Contrarian investing. This strategy is based on the principle of going against prevailing market trends or sentiments. Contrarian investors believe that certain crowd behaviors can lead to mispriced assets. When the majority of investors are overly optimistic in buying, contrarians might find assets that are overvalued and ripe for selling or shorting. Conversely, when most are pessimistic in selling, contrarians seek undervalued assets to buy. The idea is that extreme sentiments can skew prices away from their intrinsic value, and over time the market will correct, offering profit opportunities to those who went against the grain. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.